Hello, welcome to lecture 7. Last lecture I got some good feedback using the PowerPoints. I figured we might as well try it again. I'm quite happy with how well the test went. I think the average was like 80%, so really good job on that. We even had a couple students get 100%. Very proud of you. Nice job, class. So last chapter we discussed the Fed and how it can affect the money supply and influence the economy. In this chapter we're going to look at how government policy can affect the aggregate demand and affect macroeconomic variables in the short run. Let's review why the AD aggregate demand is negatively sloped or downward sloping. The three effects were the wealth effect, the interest rate effect, and the exchange rate effects. What you need to know about it for this lecture is that if you remember, the price level falls, quantity of goods and services increases, or vice versa, when the price level rises, quantity decreases. However, that isn't to say each one of these effects is of equal importance. In fact, the interest rate is the most important. It's going to have the biggest effect, and the reason I bring this up is just to say that the interest rate is going to be important for this lecture and going forward. Now, these three effects also help kind of bring up and discuss the theory of liquidity preference. This theory is going to help explain monetary and fiscal policy and how or why it can shift the curve, and it's also going to help explain the downward sloping of the aggregate demand also, as well as these three. So here's what I just said. The interest rate is going to be the most important, the wealth effect is going to be the least important, the exchange rate is going to be like the medium one or what have you. So if you remember John Maynard Keynes, he created the AD and AS model. Well, in the same book that he created that, he also developed the theory of liquidity to help explain the factors that determine the economy's interest rate. The theory is an application of supply and demand, so it's going to be familiar. According to Keynes, the interest rate adjusts to balance supply and demand for money. So if you think about it, people have a demand for the amount of money they want to hold in their pocket or in their checking account, for example, an easy access for money, and they are also going to have a demand for interest-bearing assets. So we have the nominal interest rate and the real interest rate. Going forward, when I say interest rate, you can think about either of them or both of them. It's gonna be the same either way, because in the short run, inflation is going to be zero or constant, so it's not going to really play a role in this. So real or nominal, you can think of either for this lecture. The first piece we need is the money supply. The money supply is controlled by the Federal Reserve, discussed last lecture. The primary method that the Fed used was open market operations. They bought and sold bonds, which changed the reserves in the banking system. The other two methods the Fed had was to either change the discount rate or to change the reserve requirement. In this chapter, we're just going to assume the Fed can set the money supply to whatever their goal is. If they want it to be $1 trillion, they can pick $1 trillion and have it exactly right. In this world, the money supply is not going to be affected by the interest rate. So if you have a really high interest rate, the money supply isn't going to shift. Let's go into money demand. Money is the most liquid asset and can be used to buy goods and services. Why do people demand money? We demand money because it's the medium of exchange, or the most liquid, and it allows us to purchase goods. Well, why do we think the quantity demand of money is based on the interest rate? What's the connection between them? Well, remember from a little bit earlier that people have to make decisions on how much money to hold and how much to put into an interest-bearing assets like bonds and stocks. So this is going to represent the demand for money and the demand for interest rate. This is an opportunity cost, right? The opportunity cost of holding the money in your pocket is the interest rate you are foregoing if you put it into an interest-bearing asset like a bond or a savings account or the stock market, what have you. So if the interest rate is high, are we going to hold more? We're going to hold less. We want to hold less because a high interest rate means that our opportunity cost is higher. If we hold less money, we can get a high interest rate and our money is going to be growing faster. If the interest rate is lower, it's going to decrease the cost of holding money, and that's going to raise the quantity demanded for money. And like I said, this is a supply and demand model, so we're going to have an equilibrium in the money market. There's going to be an interest rate, there's going to be a money supply, the two lines are going to meet, and that's going to be our equilibrium interest rate. You can think about it the same as any equilibrium in any supply and demand model. If the interest rate is higher than the equilibrium rate or the equilibrium point, then there's going to be downward pressure to go to the equilibrium point. So the quantity of money demanded is going to exactly balance the quantity of money supplied. If the interest rate is greater than the equilibrium, people are going to adjust their portfolios and drive the interest rate to the equilibrium point. If we assume that it's higher than the equilibrium point, we can look at it in this graph. We'll be at point R1 right here. Oh, why is this not showing up? Right here. The amount of money people want to hold is going to be less than the quantity supplied, right? So this is the quantity supplied. This is the amount demanded. So the quantity supplied is greater than the amount of money people want to hold. The people holding the excess money or the excess money that they don't want are going to try to get rid of it. They're going to buy interest-bearing bonds and they're going to deposit it or deposit in interest-bearing bank accounts, either one, because banks and bond issuers like to pay lower interest rates. They respond. The banks and stuff are going to respond by lowering the interest rate. When they lower the interest rate, we're going to be here, and then people are still going to have excess money. They're going to want to get rid of it. We're just going to inch along all the way until we get back to the equilibrium point. You can think the converse, it's going to be the same. Let's say we start at R2, we start at this point, and people are demanding more than they want. Banks want to have money deposits into their banks, and bond issuers want to sell bonds. So they are going to raise the interest rates to attract buyers. And when they do that, we're going to inch our way back up to the equilibrium point again. So in either way, if you're below the equilibrium point, there's an upward pressure to the equilibrium point. If you're above it, there's going to be downward pressure to the equilibrium point. So what does this demonstrate, right? This demonstrates or helps demonstrate that the aggregate demand curve is downward sloping again. Higher interest rate, lower quantity demanded of money, lower interest rate, higher quantity demanded of money. So this helps explain why the AD curve is downward sloping or negative. Let's look at figure 2. And we're first going to look at the AD curve. Let's assume that we start at price 1 here, and we're going to move to price 2. The price increases, quantity decreases, right? We go from Y1 to Y2, and then we go from P1 to P2. What's going to happen if this happens? What's going to happen from here when price increases? Well, more people are going to need more money, so demand for money is going to increase, right? If there's inflation, we need more dollar bills to be able to buy the same amount of goods and services. So the demand for money increases. That's going to be number 2 here. The demand shifts from this blue line to this red line. And a higher money demand is going to increase the interest rate, right? We went from this point to this point. So, or we went from R1 to R2. Our interest rate rose. A higher interest rate is going to decrease the amount of goods and services. So we can see the downward slope of the AD, right? This also helps explain why the AD is going to be downward sloping as well. Interest rate rises, quantity of goods and services decreases. Well, let's talk about the changes in the money supply. We already discussed in part why the Fed might change the money supply. Their goal is to change the AD or shift the curve. In figure 3, which we'll look at right here, we can see that when the Fed increases the money supply, the interest rate falls. So we start at this blue line, we go to this red line, the money supply 1 goes to MS2, the interest rate or the quantity of money is higher. The interest rate falls when there's more supply for money. Just think about this, if money is easier to get, then it's not as hard, or you can't charge as much to loan it out. So the interest rate is going to fall in order to accommodate for that. When the interest rate's lower, we're going to have an AD shift to the right. Firms can produce more. Firms can invest more. It's going to increase investment spending. And then consumers can buy houses and increase the aggregate demand that way. So aggregate demand is going to shift outwards, is going to increase. Well, we also discussed why controlling the money supply might be difficult for the Fed. Here, we explained that change in money supply changes the interest rate. If you this line to this line, the interest rate changes. So instead of targeting a specific dollar amount of money in the money supply, the Fed can instead target a interest rate. And they target in the real world, they target the federal funds rate, but you could target any interest rate if they wanted to, but they target the federal funds rate. And this is the interest rate that banks charge one another to borrow money, usually to meet reserve requirements or to have more reserves to pay out to their depositors. Since they change together, right, the interest rate and the money supply change together, you can think of monetary policy in either interest rates or money supply. They target a specific interest rate and they change the money supply in whatever way is necessary to achieve that goal. If the Fed decreases the money supply is going to shift left, the interest rate is going to increase. At any given price level, decrease in the quantity demand in goods services. AD shifts left. Here I talked about the federal funds rate. The main method is the open market operations. We just discussed this last chapter. Why the Fed watches the stock market. It keeps an eye on the stock market for two reasons mainly. It can help the Fed understand a bit more of what is going on in the economy. Of course, the stock market is not even close to a perfect measure of how well an economy is doing, but it does offer insight. Remember, it's really hard to forecast how a stock is going to do, if it's going to do better or worse. So basing your entire expectations on the stock market would be a bad idea. But the Fed doesn't ignore it because it's a piece of information, and it can always help have some insight to what's happening. An example could be thought of during COVID. Even though businesses were scaling back and people were not working and they weren't going out as much, the stock market was still increasing for a good period of time then. The stock market can indicate changes in aggregate demand. If the stock market is doing particularly well, this is going to expand AD, and the Fed will want to try to stabilize the AD and maybe hike up interest rates to keep the AD from increasing as much as one. And the converse is true as well. If the stock market is doing particularly poorly, then the Fed might want to try and stabilize the AD and lower interest rates to keep the AD from decreasing. The other reason is that the Fed can influence how well the stock market does by either increasing or decreasing the interest rate. It's going to affect the price of the stocks. And the stock market might become less or more attractive based on the interest rate than bonds. Maybe investors in the stock market decide, hey, the interest rates for bonds are really high. I'm going to take my money out of the stock market and put it into bonds. And if they take money, if they're taking money out of the stock market, right, that might reduce AD because companies are going to, they're not going to have as much money and they might report losses. So the Fed influences the stock market, and the stock market influences the Fed's decisions. And it also influences our economy, which the Fed wants to keep an eye on. So now we're going to talk about the zero lower bound, or the liquidity trap. I believe I mentioned this in a previous video where I was talking about the Great Recession and interest rates. During the Great Recession, the Fed wanted to target really low interest rates, and they fell to nearly zero. In this situation, what can monetary policy do to increase or stimulate the economy? They can't lower the interest rates any further. They're already at zero. It ties the hands of the Fed, and economists are going to call this the liquidity trap. If interest rates are around zero, then monetary policy may no longer be effective. They can't do anything to stimulate the economy and maybe get it back on its feet. So if the nominal interest rate falls to zero, then people won't loan out money because they're not gaining anything, right? They're just going to hold on to their money. Some economists believe that this is a small issue and that the Fed has other tools to stimulate the economy past this. The Fed can target the same low interest rates for long periods of time. And by making the promise to keep low interest rates for a long time, people might still be willing to invest. So it might actually increase investment spending, even though they're not really like lowering the interest rates any further. They can also engage in what we call quantitative easing. Quantitative easing is a sort of unconventional monetary policy that lowers the interest rates or mortgage-backed securities and longer-term government bonds. During the Great Recession, we engaged in both types. We did open market trading, and we also did quantitative easing. Other economists say that we can target inflation to be a negative rate. Even if we're in this liquidity trap, if we target a negative inflation rate, then the real interest rate could never go below zero, because if the nominal interest rates are zero, inflation is negative, our money is appreciating, and we'll still want to put our money in interest-bearing assets because it goes 0%, but then the deflation occurs in this case, and our money increases in value. However, a higher inflation rate is going to give policymakers more room to make decisions and stimulate the economy when it's needed. If the inflation rate's at 5%, they can target a lower inflation, they can target higher inflation, they can increase or lower the interest rate. They have a lot more options than just keeping the nominal interest rate at zero and forcing the inflation rate to be negative. So let's move on to fiscal policy. Before we focused on the Fed and how the Fed can influence the economy through monetary policy. But we haven't talked about how the executive and legislative branches of the government can influence the economy. So just think of decisions from Congress and the presidency. Maybe the judicial branch has some influence on this with declaring maybe some policies unconstitutional and it has to undo these, but that's going to be very minor and they aren't going to be making big splashes very often, or if at all. So they're very negligible in the sense of changing aggregate supply and aggregate demand. So you want to think about the budget, you want to think about taxes and its influences on economic values like savings, investment, and growth. So the primary effect of fiscal policy is going to be through and on aggregate demand. The Fed influenced AD indirectly, right? When they increased the money supply, AD kind of shifted upwards because people wanted to spend more, but the Fed is going to do it directly. So if you recall the AD, how we created it, we basically took the GDP equation, C plus I, and then we ignored government purchases, and then we had net exports. But let's just add government exports into it now. It's going to have a direct effect on aggregate demand. If government increases spending, AD is going to increase. So let's think of, let's assume the government places a $20 billion order for new fighter planes with Boeing, which is an airplane company, and that's just going to directly increase the demand for the output produced by Boeing in this case. Boeing is going to hire more workers and they're going to increase production. So even though the government just spent $20 billion, which directly increased the aggregate demand by $20 billion, there's actually going to be multiple effects. So after the $20 increase in spending, when the company hires more workers and increases production, those workers are going to have more money and they're going to increase the AD. So your first instinct may be to say, oh, it just shifts the AD 20 billion, but it's going to be a little bit more complicated like that. The first effect we're going to look at is the money multiplier effect. So the government buys 20 million or 20 billion at Boeing, and Boeing hires more workers and increases wages. The workers increase consumer spending. As a result, 20 billion raised the demand for other products in the economy. And of course, those firms do the same thing as Boeing. They hire more workers, and there's a whole nother round of this, and it's just going to keep compounding and adding up. So it's going to be multiplying by a big number. So here, the initial shift is caused by the government spending $20 billion, and then the multiplier effect is going to push the AD even further out than it was. This is pretty cool. Well, I'll go into a little bit more of why it's so useful and why it might be important in a little bit. So what is the multiplier effect? And we're also gonna look at a formula for it. An important number in this equation is the marginal propensity to consume. This is the fraction of extra income that consumers spend rather than saves. For example, if you give a household one more dollar, how much of that dollar are they going to spend and how much are they going to save? Let's say I give them $1 and they spend 75 cents and save 25 cents. The marginal propensity to consume is going to be 3/4. They spent 3/4 of the dollar. They saved 1/4 of it. Let's look at the equation. We're gonna see how the equation is formed to find our money multiplier using our marginal propensity to consume, because it's going to be the most important variable in this. So our equation, and the one that you need to know, is that the money multiplier is going to be equal to 1 divided by 1 minus MPC, or the marginal propensity to consume. How do we get this equation? Well, we're going to add the 20 billion, and then this should be a 1. So that's incorrect. I should correct that. I'll upload a new PowerPoint. So, and then it's correct down here if you look. So it's going to be 1 plus MPC squared. So this should be a 1 and then MPC squared, MPC cubed, and so on and so forth until forever, technically. Goes to infinity. When this happens, if you know your math, you can factor out the marginal propensity to consume in each, or you factor out the 20 billion in each case, and you're going to left with this infinite geometric sum. If you've taken Calc 1B, or maybe they deal with it in Calc 150A, I don't remember exactly. But the equation is going to be this. Spending over 1 divided by 1 minus MPC. However, the money multiplier isn't the only effect that presents itself when fiscal policy increases. There's another one that's going to have an opposite effect. So the money multiplier increase aggregate demand even further, but there's going to be another effect that's going to decrease AD. But real quick, I just want to say the reason why the money multiplier is important is because in early economics, when we talked about fiscal spending, right, you would raise taxes and there's deadweight loss and people were worse off. However, if fiscal spending increases and there's money multiplier effect, maybe potentially this money multiplier effect can outweigh those costs, because the extra benefit that's coming from this might outweigh the costs. You'd have to do a whole analysis on it, but that's just one thing to consider when you are looking at policies. That isn't to say that it's always good, because the next effect we're talking about is the crowding out effect. This is going to offset the aggregate demand. It's going to decrease it. When government increases spending, they raise the interest rates, which is going to reduce investment spending and it's going to put downward pressure on AD. Why are interest rates increasing? What's happening here? Well, when the government spends money and people from Boeing get more money, households plan to spend more money, and they choose to hold more liquid wealth. See, it comes back, meaning the demand for money has increased. From like, if you remember figure 1 or figure 2, you can scroll back in the video, or if you have the PowerPoints open, you can look at it. When money demand increases, the interest rate rises, right? It increases. And it's going to decrease the quantity of goods and services demanded. It's possible that the crowding effect is large enough that the AD shifts is less than 20 billion. It's less than what the government spent. That's a big deal. And I'm going to slide back to the page to show what I mean. Not this one. We are going to here, right? Oh, no. We want even further back, actually. We can, okay, here. So the interest rates are here because the money demanded is higher than the money supplied because the money demanded increased. So we went from here to here, and that's going to push it back up, right? So we're going to move back to the equilibrium point, which is why the interest rate rises when the money demand increased. So we increased over here, and now we're moving back and raising back the interest rates. So we are on slide 35. I hope that helps explain what I was talking about. Next, we're going to talk about the changes in taxes. Taxes are a big component of fiscal policy, determining how much they want to tax us, how much they need, or if they want to do tax cuts. So we're going to look at taxes. Here, we could see the exact same thing, by the way. MD increases, the interest rates increase. The interest rates are going to push the AD back. So the 20 billion was to this one, the government purchases, and then the crowding out effect is going to push it back in. So let's talk about taxes. A tax cut for personal income is going to shift the AD to the right. More people are going to have more money. They're going to spend some. They might save some, but they're definitely going to spend some. Both of the effect we talked about previously are going to take place here as well. It's going to affect when taxes happen. We're going to have a multiplier effect, right? Because more people have more money. They buy more product. That changes the AD for those products and it increases, and then they produce more, right? That's going to be the same thing. Crowding out effect, also the same thing. Their demand for money might increase, and then It's going to raise the interest rates a little bit, which is going to decrease the aggregate demand. So both of them are happening. However, there's another thing. There's another determinant about how big the sizes of this shift is going to be. We have to consider the expectations of the people. Remember, it was important in the AD and AS model. Keynes thought expectations were really important. They're important here too. Do they think this tax cut is permanent? Do they think it's temporary? Think about the stimulus check we got from COVID. That was a temporary tax cut, right? Or maybe just dropped, right? Like money dropped into your hand. Do people spend a significant amount when they get when they got their stimulus check? Maybe, but for most people, probably not. They weren't too sure about the future. They probably needed to save a lot of it for rent the next month or food the next month and whatnot. So it doesn't represent a permanent increase in income, and they're only going to spend maybe a bit of the check, but they probably won't spend all of it. They might just save it. Because it doesn't change their income. It doesn't change their consistent purchasing power. So if it's a permanent change, people are going to spend more each month or each year. If you think about a tax cut, that might be like almost like thinking about increase in income or like a promotion. You are getting more money for the same amount of work, and you can now afford more things. You're going to purchase more things regularly. They won't feel the need to save it because they believe that their future income is going to be higher. So they're going to elevate their standard of living and they're going to spend more than they normally do. So a permanent tax cut is going to have a large impact. A temporary tax cut is going to have a small impact. All right, we have talked about fiscal effects of AD, and that is the most, that's like the most important force is aggregate demand. Most economists believe that these forces work through AD and change AD, shift AD, but the aggregate supply can also change. It may also change AS. If workers make more money, they may work more hours and produce more. The quantity of goods and services increases. It's just might shift the supply side. The quantity of labor increase in that sense, right? Or the supply of labor, I should say, not the quantity of labor, the supply of labor. There are economists who believe so much so in the supplied side more than the AD and are proponents of like corporate tax cuts. Some supply siders believe that the tax cuts for firms would increase aggregate supply so much that the tax revenue would actually increase. That is, if you can think about it, they may cut taxes on government or on firms by 10%, which lowers the tax revenue by 10%. But because the companies are now producing so much more and their profits are so much higher that they actually pay back 15% in tax revenue. So even though we gave the corporations a tax cut, we actually increased taxes or the amount of taxes we have. Which, if possible, there's going to be a line, because if you think about marginal changes, there's going to be a point where you can't increase or decrease the taxes anymore and get more money. So there's a balance. There's a whole curve that we're not really going to discuss here, but maybe if you keep taking econ classes, you'll see it. Now, government purchases can also influence aggregate supply. Before we talked about how government purchases or government spending affects AD, but it can also affect aggregate supply. Let's say the government purchases infrastructure. We'll use an example that might seem a little bit weird. We're going to say roads. If they purchase new roads or develop roads, private businesses are going to use those roads to deliver items maybe, or to ship things between the two factories or what have you. And this might seem a little weird, but it's going to increase production. because maybe their cars don't break down as much, the heavy trucks don't go over the bumps and the axles don't get messed up or what have you, the tires don't get popped as much, so they can increase production. Maybe they don't waste as much gas because it's harder to go through the bumpy roads than a smooth road. Or maybe they create a new road that makes it quicker for the things to ship so they don't spend as much money traveling. It's also possible that a government pays for like a park or something, increases aggregate demand, not aggregate demand, sorry, increases government spending to build a park or to maybe section off a land as a natural reservation like Yellowstone National Park or anything of those. Private businesses could open up around the park and, get some of the, I guess, revenue from the people who are going to the park or enjoying the park or things like that. And that's going to increase production of goods and services. Before, there was a lower amount of goods and services and they created a park, businesses opened up, so that they increased the quantity of, or the amount of goods and services produced. And the very last thing we can talk about for this lecture is using policy, whether it's fiscal or monetary policy, to stabilize the economy. We're going to go over these things. Here, if you want to talk about President John F. Kennedy, he had a tax cut. People asked him why. And he was like, oh, haven't you taken Econ 101? It's to stimulate the economy and to get it moving. And then also in 2009, we passed the stimulus bill, which increased the government spending for the American Recovery and Reinvestment Act. I kind of already talked about these in the generic case, so they're there if you want to look at them and study them. We want to look at stabilization. So, what if the government decides to raise taxes? Well, we know in the short run, AD is going to fall. People are going to have less money. It's going to depress production and employment in the short run. Well, what if the Fed begins monetary expansion at the same time government decides to raise taxes? Well, when they engage in monetary expansion, it's going to reduce the interest rate and it's going to stimulate investment spending and it's going to expand aggregate demand. So the fiscal policy is decreasing aggregate demand and the monetary policy is increasing demand. In this case, we have two opposing forces. During the Great Depression, this might be, there was a case of this. Herbert Hoover decreased the money supply, and then when FDR, Hoover also tried to engage in increasing fiscal policy. Not a lot of people give him enough credit for that, but FDR, Franklin D. Roosevelt, he was really big on increasing fiscal spending and government purchases, but because the Fed shrunk the money supply and did contractionary monetary policy, even though he was increasing fiscal policy, the two were in opposing forces. FDR was trying to increase aggregate demand, and the Fed wasn't trying to decrease aggregate demand, but that's what they were doing. They didn't know exactly how changing the money supply was going to work, so they were working against each other. A good system is when these two things work together. When both the Fed and the government have the same goals, then they can better achieve whatever goals they're having. So in 2009, with the Great Recession, Obama increased fiscal policy and the Fed increased the money supply, both stimulating the economy. So they were working together, which is why we had a very successful recovery from 2008, 2009. I think we're already back to where we were by like 2012 or so, maybe a little bit later. I'm not exactly sure, but the recovery was much faster than the Great Depression. It didn't hurt as badly because both of them were in sync. They had the same goal and they were working together. It's really important that both understand what the other one's doing and the effects the other one is going to have on the economy, and that they both have the same goals. In some cases, maybe they don't. Maybe the federal government has a plan set in motion, and even though the Fed has a different plan, right? They are focusing on interest rates, inflation, and unemployment. Maybe the Fed or the federal government is focusing on external things, like outside of that. They could just be focusing on wanting to build certain buildings or infrastructure, even though that's not what the economy needs at the moment. But that's what the federal government wants to do. It's not bad, but those forces can conflict. Since the Employment Act of 1946, the government and the Fed, their goal has been to promote full employment and production. This is so that the federal government, when there's a recession, they should try to increase AD and vice versa. Keynes argued government should actively stimulate aggregate demand when aggregate demand appears insufficient to maintain production at its full employment level. Keynes argued that the reason AD fluctuated was largely because of irrational waves of pessimism and optimism. He called these our animal spirits, because we just kind of went with the flow, or just kind of had moods about what was going to happen in the future, even though it wasn't really realistic or based in logic. If they're overly pessimistic for whatever reason, they just feel that in the future things are going to go bad, they're going to reduce spending, they're going to try to save as much money for when the bad thing happens. And if it's optimistic, the opposite's going to happen. Maybe they spend more than they should and they're not saving as much as they should for the future. Because they think in the future, oh, I'm going to be making so much money, I don't need to save any money right now. You could think of this as maybe a young teenager or a young adult. A lot of times when they are working, they're very fine with spending because they're like, oh, I'm going to be making so much money in the future, I can spend more now and not really worry about it. But maybe that's being too optimistic, right? Now, the Federal Reserve can try to stabilize these emotions based off of the interest rates or the money supply. They can kind of change how people think by saying, oh, maybe they think the economy is doing really badly, but then the Fed kind of manipulates it so that it looks really good. Then maybe the pessimism kind of goes away. Maybe the optimism, and then vice versa could happen, right? The Fed tries to make it look a little bit worse, and it's not so bad. Okay, so let's go back to the case against active stabilization. Some economists argue against using these tools to influence the short run, and that policy from the Fed and the government should be focused on long-run growth and low inflation. Their main argument is that these policies have lags to when they are needed and when they are put in place. The Fed says that monetary policy can sometimes take up to 6 months to work or just to see if it might work. And firms plan investment projects years in advance. So if the Fed is trying to change the interest rate, the firms already decided a few years ago what they wanted to do, and the Fed can't really influence, or it's too late to help these firms that have made these decisions. They argue against monetary policy. They don't argue against, they argue monetary policy should be passive, and that they just want a slow and steady growth in the money supply. A famous advocate of this was Milton Friedman. He was a Keynesian that came after Keynes, shortly after. I think he was popular in the 70s and maybe the 60s. He argued that he was a very big fan of monetary policy, and he was called a monetarist. Basically, where Keynes believed that the government should use fiscal policy and that the money supply should be kind of stationary, Milton Friedman argued the opposite, that fiscal spending should be small and constant, and that monetary policy is the one that should be changed or influenced. So we saw how monetary policy might have a lag, right? They pump money into the system and it takes time for the interest rates to change. And by that time, maybe the economy would have already gotten over it. So by the time the change actually occurs, the Fed is actually just messing things up. Well, what about fiscal policy? Does that have a lag? Yeah, it does, but it's due to a not how long the fiscal policy takes to change things. It's more due to the political processes. The government decides to increase fiscal policy, right? So Congress, well, more accurately, the House drafts a bill. They get a committee together, they all decide, they think about what they want to do, they draft a bill, gets revised a couple times, and then finally it goes to the floor, and they start arguing and debating over it, and they start making compromises of what they want on the bill, and eventually they'll get a redraft, right? And then it'll get up to the floor of the House again, and then let's just say it passes. Sometimes it can go through a few cycles of that, but let's just say it passes, and then it goes to the Senate. And then the senators are like, hey, I want to add this in there, I want to take that out. So then they go through a whole mess all over again, right? The Republicans and the Democrats and whatever parties are in there, they try to get it the way they want. So then it goes through more revisions, and they have a committee that also helps with that. And it may not even get passed at this point. It might have already taken a few months. So it's been a good amount of time. And then let's just assume that the Senate passes it, right? Then it goes to the president. The president can choose to veto it, or he can sign it into effect. If he vetoes it, it's going to go through the whole process again. Maybe the Senate looks at it and says, hey, we really want this, and they push it, and if they get, I think it's like 66%, they can move past the veto. So that's a long time, right? From when they started the policy to when it gets put into place, the economy could have already adjusted, and then the government is just throwing this fiscal policy out, and it's messing the whole thing up. That's here on this next slide. It's a kind of dramatization or a political comic cartoon where it kind of discusses effects. You have, I'm guessing this is it was one of the founding fathers. He was writing. I don't remember his name right now. Um, but he said, the British are coming, and this one, it's the recession is coming, and then the next one, the recession is here, and the next one, the recession is over. But then the government comes in and is like, hey, wait, no, I have a stimulus bill. So like, even though the problem's already solved itself, and in the short run, it's been solved, we can focus on long run things. The government's like, wait, no, I had something for this, and it kind of just messes things up again. So that's why advocates say the fiscal policy and the monetary policy should focus on long run, and we'll just let the short run stuff kind of fix itself and edge itself out. Keynes was against this because who knows how long the long run is. He's quoted as saying, in the long run, we're all dead, so we should focus. Well, he didn't say that we should focus on the short run, but his famous quote is, in the long run, we are all dead. But both these critics and advocates agree that there are potential problems. These lags are potential issues. Well, we found a way to adjust for these, and we're going to call them automatic stabilizers. They are changes in fiscal policy that stimulate AD when the economy goes into recession, but that occur without policymakers having to take any deliberate action. One example is the tax system. Taxes are based off how well the economy is doing, even though it may not seem like it. Depending on the household's income, how much money they pulled in, how well they're doing. Payroll tax depends on workers' earnings, how much money they're making. And corporate taxes depend on profit, how much they're making. So all of these are kind of factors on the economy. If they're not doing very well, right, the profit's going to be low, the workers' earnings are going to be low, households' incomes are going to be low, so taxes are going to be lower. So it's automatically adjusting for how well the economy is doing. Another one is the welfare system. When the economy is doing poorly, people are laid off and apply for unemployment insurance. and other forms of support. This will automatically increase government spending without the policymakers having to step in, and it's going to increase aggregate demand exactly at the time when aggregate demand is insufficient to meet the requirements of the Employment Act of 1946, which were to have full employment and productivity or production. These stabilizers, however, are usually not strong enough to stave off recessions. They don't actually fix the issue, which is why we still engage in monetary policy and fiscal policies. And policymakers, when they're making decisions on how much to spend, how much not to spend, and so on, they really need to think about the effects of all their decisions. Some people have advocated that the government should always be in balance with its budget, so we're never in a deficit, and that would force policymakers to really think about the repercussions of what they're doing, or how much money they want to go in debt, and so on. But that kind of concludes this lecture. We examined short-run effects of monetary and fiscal policy, how that influenced aggregate demand, aggregate supply. We talked about the ways to stabilize the economy. Thank you. That covers this lecture.